Welcome to this presentation of the national accounts for the first quarter of 2020. These results are provisional, so they come with that provision, I suppose, that people should be aware that they will be again revised later in the year together with our annual national income and expenditure results. So these results, as we said, have been brought out are in the COVID environment. So there is a warning there that you should consult the documentation on COVID and its impact on various CSO data sources when trying to assess the overall message that we are providing here today. Okay, firstly, turning to the first quarter of 2020, you see there on the graph the trend in GDP. It's upward sloping, which may come as a surprise to some of you. It's an increase of 1.2% in GDP. It's important to note that there are a number of developments in the economy that are coming together here. Firstly, we have the COVID restrictions in the final 2 weeks of March. But in addition to that, we have globalization events that have also taken place in the quarter. So it's a combination of a number of things that give us this result. GNP showing an increase of 0.1%. Now, the next slide presents the change in GDP across some of our partner countries in the EU. So we see there, for example, the European Union, the 27 countries that now consist of the EU, showing an increase of 3.3%. The euro area showing an increase of minus 3.8%. On the extreme left, we see Spain accounting for a decrease of 5.2%. What we see is that there are negative results in general being recorded by many of these countries. The only positive ones being Romania at 0.3%, and Ireland 1.2%, and Sweden showing an increase of 0.1%. Moving on to the sectors of the economy by their share of GDP, we look at each sector there, and it explains its importance is explained in terms of its slice of the pie. We see industry showing an increase of 15.4%. Distribution, transport, industry is a very globalized activity, and this is showing a very strong increases in the quarter. These are a combination of factors at play here. We have increased exports, particularly in the pharmaceutical area, and also we have reduced royalties, imports of royalties. So what's happening is we have increased sales and lower costs associated with those sales. This has resulted in a very strong result for this sector, an increase of over 15% in the quarter. Distribution, transport, hotels and restaurants. This is a sector that's very impacted by the COVID restrictions. It's showing an increase of, or rather a decline of 12.7% in the quarter. Information and communications dominated by the IT sector and the social media companies. This is showing an increase of 1.5%. Professional admin and support services, another sector that's been impacted by COVID restrictions. It is also showing a decline of 5.3%. If we go on to the next slide, we'll see the trend of a few of the key sectors in the quarter. So we can look at how things evolve over the past few quarters for these same sectors. What we've done here is to show the sectors impacted by COVID-19 with the dotted lines. So we see there at the top, that's information and communications. That has shown the strongest growth in the economy over the last several quarters. Below that, the yellow line, that's the sharp yellow line, that is a sharp increase in that, reflecting the increase of over 15% in the quarter for manufacturing. Below them then, we see the various COVID-19 impacted sectors of construction, the first one in green, followed by professional admin and support services in brown, and then the key sector, the distribution, transport and communications, that's the pink dotted line. And then on the black dotted line is not an economic sector, it's in fact a reflection of taxes less subsidies paid in the economy. So what's happening here is that the taxes, and we're talking about taxes on products and production, so it's VAT mainly. We see the fall in VAT that has occurred because of the reduced sales of products in the COVID-19 environment. People are buying less, basically, paying therefore less tax. And then we have the labour subsidy that the government is paying to firms to retain employees on the books, even in cases where they are not fully occupied. So that is showing a decrease of over 38%, so it's very significant. So it's included for that reason in this sectoral picture. Moving on then to the expenditure side of the account. So we're looking now at GDP in terms of final demand or spending. We firstly go to personal consumption expenditure. That's showing an increase or decrease, a decline of 4.7%. Government spending is up 0.5%, while investment, which is impacted very significantly by imports of intellectual property products, is still showing an increase of 0%. The reason for this is that we have very significant imports of intellectual property products in the current quarter, but we had similar sized imports in quarter 4. So when we compare quarter 1 with quarter 4 of 19, we get a very similar picture, resulting in this overall no change in investment. Then looking at exports and imports, we see exports showing an increase of 0.2%. It's important to note again, we're talking about the seasonally adjusted results here. We're comparing against quarter 4 of 19. In the quarter 1, we had some of the largest exports, or highest exports of goods in Ireland, in most countries of the world at that stage, and proportionately. And it's important to note that this figure for exports includes both exports of services and exports of goods, which show a different trend. Similarly, on imports, we see a decline of 1.5%. We have, like I said, very substantial imports of intellectual property products, but there were similar ones in the previous period. So overall, we have a reduction of 1.5%, reflecting largely the fall in imports of royalties, which we mentioned earlier in explaining the performance of manufacturing in the quarter. Overall GDP, like I said, showing an increase of 1.2%. We've included then a few slides from the retail sales, and what these aim to show is just where are the declines being observed in the activities of households and individuals, and where are the increases being experienced. So I think it's everywhere where we expect it to be. So when we look at the chart there, we see bars and restaurants are down by over 53%. And that's just accounting for the 2 weeks in that month. So this is just for March, and we're comparing March against February in 2020 compared to March against February in 2019. So it's comparing the 2 Marches really in 19 and 20. And this is a very different picture we're seeing here. And firstly, like I said, bars well down by 53%, but we know that they were identified as key areas for spreading COVID and have been closed for 2 weeks of the 4. Clothes showing a decline of almost 50% too, 49.3, compared to a very minor change of minus 1.3 in March of 2019. Motor trades, department stores, furniture, all these sectors where we expect to see the reductions are there. And then we have the increases at the bottom there relative to Q1 of 2019. We see increases in pharmaceuticals and increases in food, beverages and tobacco. And we all know this from our experiences in supermarkets and in chemists since the restrictions have been introduced, or the incidence of COVID. Another key aspect of this is the behaviour of consumers. How are people behaving in this new economy? And what we wanted to show here is the percentage of online sales. So how are people changing their behaviours to deal with the shutdown or the closure of certain retail outlets and so on. Now what this slide is showing is the change over 3 months. It's showing, comparing April with March and February of 2020. So we can see how online trading has evolved over those 3 months. And we see in particular for retail sales of textiles, clothing and footwear, they're up at 81% of all purchases are explained by online trade. So 81% practically, close to all of it. For retail sales of electrical goods, 60% now. But even when we go back to March, 15% were being traded online. And we go on to various other headings there that all explain an increase in the purchase online of products that cannot be accessed on the high street now. Okay, so we move on now to looking in some more detail at aspects of net exports, final domestic demand, and how these globalization impacts are shown in our economic results. So firstly, what we have here in this slide are exports and imports. So the green bars are exports, the blue bars imports. And what's striking there is that the blue bars are very, very close to the green bars in size. This is unusual for Ireland, and when we look back over the quarters, we see how the blue bars are maybe 2/3 of the green bars, and that's the way it has been for many quarters. But certainly in Q1 of this year, the current quarter, Q4 of last year, and Q2 of 2019, we see very significant imports being recorded too. And the reason for this is because we have very substantial imports of intellectual property coming in for a lot of multinational corporations that are now bringing onshore assets that were being held elsewhere. What we see then is that we look at firstly at net exports. So this line shows us what the effect is, or what the impact of when we subtract exports or imports from exports, what's the net picture. And we see there the net picture, it rises sharply in Q3 of 2019 when we had much lower imports, naturally. But for Q4 of 2019 and Q1 of 2020, it's almost flat, and we see a net export figure which is largely flat. Then introducing the line for final domestic demand. And what final domestic demand is, we're adding investment to customer spending to government spending. And what happens with this graph, or this line, is that it is being driven by, again, imports of intellectual property. So as these imports come in, our total investment picture increases. So when we look, for example, at that line for Q4 2019 and the current quarter, we see a line that's almost flat, not quite, but and that reflects the high levels of imports of intellectual property that occur in both quarters. However, if we go back to Q3 of 2019, we see a different picture, and we see a decline in investment, or a decline in domestic demand, because of the reduced level of investment and the reduced level of imports of intellectual property products. Now, when we try and deglobalize this picture, in other words, try and show, well, what's happening beneath all of this in the economy, we have this line, the black line there, which is modified final domestic demand. So this is those same elements: personal spending, government spending, and investment. And what we're doing is we're excluding these globalization events. And what we get then is a much more sort of moderated view of how the domestic demand has evolved in the economy over the past several quarters. The overall result for Q1 2020 is minus 1.8%. Now, moving on to another view of the contribution of domestic demand and net exports to GDP growth. The objective, or what we try to do with this slide, is to show growth in the economy, the 1.2% overall growth in GDP, and explain it in terms of the growth in domestic demand and the growth in net exports. What proportion of that 1.2 is explained by each of them? In the slide below it, what we do then is we modify both domestic demand, we exclude these imports of intellectual property, and then for net exports, we also exclude the imports of intellectual property. What's interesting, or what's a bit puzzling for some people perhaps, is that the result is the same for Q1 2020 in both presentations. And what the result is that net exports explain 3.3% of the growth in GDP, whereas the modified total domestic demand, or total domestic demand, the unmodified figure, both explain minus 2.1%. When we subtract the two, we get our growth of 1.2% in the economy. But this is because of what we had looked at in the previous slide. The scale of imports relative to exports is practically the same in both periods, and that has resulted in a very flat picture overall. And even when we modify them, we're taking the same amount out of both sides, and we end up with a very similar result. Okay, just then looking at personal consumption expenditure, as we said, that is showing a decline of 4.7%. So this is the most seriously impacted area of the economic picture that we're presenting today. And this is seriously impacted by the COVID-19 restrictions. I think we can all understand that, because it is having an impact on all of us in our day-to-day lives. Goods are showing a decline of 5.2%, and we went through this earlier in the retail sales analysis. Services showing a decline of 0.8%. And then moving on to investment. This is a difficult slide because it is telling us practically nothing. What it is telling us is that most of the data is confidential. So because of these imports in intellectual property are a number of discrete transactions, they are generally confidential in nature. And then to protect the confidentiality, we have to introduce some controls for secondary confidentiality. This is just further strengthening the confidentiality controls, but that means that we can only present building and construction in this slide. So that is showing a decline of 1% in the quarter. The overall picture for investment, if you look at the composition of it, we see there the blue sort of shaded lines. What they are presenting is the confidential data that includes both machinery and equipment and also intangible assets. Typically, the machinery and equipment is dominated by aircraft being imported for aircraft leasing, and the intangibles will be typically intellectual property products coming in. So we can see also that for construction, we see the impact of the minus 1% fall in the quarter. Then just looking at the transition of GDP, we've been talking really about the trends in GDP up till now. Looking at how does GDP transition into GNP when we exclude the profits that go back to the owners of capital abroad, that are the owners of multinationals operating in Ireland. And we see that GDP itself showing an increase of 1.2%, and that's reflected in a slight increase in that blue bar relative to the blue bar in Q4 2019. When we look at the factor outflows, there are these profits, largely profits going back to the owners of multinationals here. That's showing a movement of 19.3 billion in Q1 2020 compared to minus 20.5 billion in Q4 2019. So we have I suppose a lower subtraction or a lower outflow in quarter one compared to quarter four, but then we have lower GDP, or rather GDP is increased by 1.2%. It's a matter of the rate of change of both of them. But consequently, anyway, the increase in GNP is showing an increase of 0.1% in the quarter, practically flat. No change really relative to the previous quarter. So just to summarise then, for the seasonally adjusted results, for the quarterly summary, for these provisional results for Q1 2020, personal consumption expenditure, like I said, the key area or set of spending that's impacted by COVID-19, showing a decline of 4.7%. Government spending up 0.5%. Investment largely flat, but that is there's a lot behind that 0% in that we have very large levels of investment, but just they are similar in size in both Q1 and Q4 of 19, giving us overall a change, a flat transition from Q4 19 to Q1 2020. Net exports almost 2 billion, 1.8 billion. And then looking at some of the indicators, and final domestic demand showing a fall of 1.3%, and then our modified indicator, modified final domestic demand, showing a decrease of 1.6. Two figures, again, quite similar for the same reasons that we spoke of earlier. Then on the output side, or the value-added side of the economy, industry, as we said earlier, very large exports, and also a reduction in the costs of producing these exports with the fall in royalties, showing an increase of 15.4%. Construction down 1.6%. Information and communications up 1.5%. Professional admin and support services, they're showing a decline of 5.3%. And like we said, that includes both aircraft leasing activities and also things like all sorts of engineering, accounting, advertising, all sorts of business services that are supplied. Public admin, almost flat at 0.2%. Financial and insurance activities showing a decline of 0.4%. And another, if we think of personal consumption being the key sector on the expenditure side of GDP, on the output side, it's distribution, transport, hotels and restaurants, where the key impact of COVID-19 is, and we see a decline of 12.7% there. And we've talked earlier about the net factor outflows, slightly down on this quarter, the quarter of quarter 4 2019, 19.3 versus 20.6 billion. So just finally to talk very briefly about the year-on-year growth rates. So up till now we've been comparing Q1 2020 with Q4 2019. We are now comparing Q1 2020 with Q1 19. So it's a different comparison. GDP is showing an increase of 4.6% compared to Q1 2019, and GNP showing an increase of 5.5%. On the personal consumption side, we see goods declined by 4.3%. Same story really. We have very sharp decreases in this quarter relative to either the previous quarter or the same quarter in the previous year. So that's showing a decline of 4.3% in goods and a decline of 1.2% in services. And this is a broadly based decline, and we've gone through a lot of the sectoral analysis earlier on in some of the slides from the retail sales. On the investment side, we see building and construction showing an increase of 8.3%, and of that, new dwellings, obviously new dwellings up till the final couple of weeks in March, showing an increase of 17.3%. All other building and construction up 5.9%. And now this final statistic really shows us the impact of these intellectual property products, that what they have, the impact they can have on the investment numbers. So we see there the remainder of capital formation, which includes machinery, equipment and intangibles, and that's showing an increase of 286 or over 286%. So obviously no imports of intellectual property or much smaller imports in Q1 of 2019, yes. And so it just shows that the impact that having the same levels of imports in the same quarter on a seasonally adjusted basis is showing almost zero change in capital formation. When we look at it here and we compare against a quarter that didn't have these imports, we see huge numbers, huge increases in investment, like practically 300%.
I have the international accounts for Q1 2020. These are largely unaffected by COVID-19, but importantly we have seen some changes in how multinationals work and how they manage global value chains out of Ireland. In particular, this quarter we've seen a large increase in the production of pharma companies related to a number of factors. One key issue this quarter is that we have large imports of intellectual property, as in last quarter and Q2 of 2019 also. So these run of factors give us a set of results which are, as usual, a little complicated for the multinational activity, but they are showing some clear pictures of what's going on in terms of pharmaceutical activity. If we step back a little bit and look at the international accounts as a whole, we can see that these tell us a story about goods, services and income, and how that sums to give us a current account balance of minus 15.2 billion in the quarter. This is related mainly to the services balance you see in the middle of our infographic on the left-hand side, and that's about imports of IP in the quarter. We can also see there on the left-hand side about goods and profit outflows. Our publications also show us about what happens to all the income derived from this activity in terms of financing, FDI into Ireland and Ireland's net liabilities. However, our headline indicator is the current account balance as a share of GDP. This has now gone to minus 17.1%. Affected by IP, as we saw last quarter and again in Q2 2019. When we look below the current account balance, we can see it's made up of goods, services and income. The services deficit is driven by IP in the quarter, but there is a story there behind goods increasing by 2.2 billion on the same period last year, and a modest increase in the outflows of net factor income, have increased by 389 million. We can look at those balances over time to see the IP effect in green there, where we see a services deficit in 3 of the quarters presented on the chart. Behind each of those balances, we can see exports and imports. So when we look at goods exports, we can see a 2.3 billion change in Q1 2020 over the same period last year. And this is driven by cross-border pharma exports, which you might have seen in our monthly trade and goods release. Merchandise imports are fairly small, the increase, up 49 million. Services exports are up 5 billion on the same period last year, and this reflects the strong growth we continue to see in computer services exports. Service imports is the IP story we've already alluded to, up 33 billion on the same period last year, And then to look at income flows, we tend to concentrate on that related to production in Ireland, the direct investment income inflows and outflows. The inflows are up, seasonally perhaps up $1 billion, as dividend payments are often made in Q1 of each year. And then the direct investment profit outflows are also up by approximately $1 billion, just under $1 billion. If we spend a little bit of time looking at the detail behind goods, services and income, we can see the interesting story with goods that pharmaceutical exports, the cross-border pharmaceutical exports, as shown on the left-hand side here in the green bar, have increased in Q1 2020. And this is really the story, I guess, of the quarter, what's going on. It's not so much increases in our other adjustments to get goods from the cross-border to our BOP and national accounts concepts, but the original cross-border exports and manufacturing, but mainly pharmaceuticals. We have tables on this, so you can check if you're interested in what the detail is on these factors. We can look at contract manufacturing, our conceptual adjustments and merchanting. And you see, while there is large changes, in particular on contract manufacturing exports are down nearly $4 billion. The conceptual adjustments are lower on exports too, so there tends to be no net effect there on the other globalization factors. So we can clearly see with goods that the main feature in the quarter is the increase in cross-border goods. In terms of services, this is a familiar picture to us, seeing quarter on quarter, and in this case year-on-year rises in computer services exports dominating our total exports. So the total exports of services are up $5 billion, and 4.6 of that is computer services. On the import side, this is the dominant feature of IP, bringing IP into Ireland. We've imports of IP of nearly 33 billion, which is what the overall increase is on service imports. Royalties and licenses have reduced slightly by 234 million, and we've another chart on that to show you a little bit more detail. So if we look at royalties by sector, which sectors are paying royalties, paying foreigners for the use of intellectual property, we can see a noticeable fall in that in the pharmaceutical sector. The rest of the sectors are marked confidential, mainly because of ICT, and we've shown the total there as the blue line. So you see the total in blue with the decomposition into ICT and pharma, but the last number of quarters, because ICT is confidential, we've had to suppress that. But the interesting story, I guess, for the quarter is we've seen repeated amounts of IP moving into Ireland, and particularly last quarter and this quarter. Those companies have made decisions about paying less royalties, and we've also seen some other companies in manufacturing, particularly pharma, increase production in the quarter to increase stocks as a result perhaps of COVID. So that's definitely the most interesting point, I guess, for the quarter. If we then spend a little bit of time looking at income, we see some seasonal effects here. Q1 is usually up with dividend payments on the direct investment inflows, and on the outflows, that's up also by about $1 billion to 22.6 billion. We did see some unusual large dividend payments out of Ireland, so we've been watching that over the last number of years, depending on what's going on with the US, and see if we can see some effects in terms of movement of money in and out of Ireland. If we look at the profit outflows by sector, like we did with royalties, we can also see a large increase in manufacturing profits here. I'll put a little bit of caution on this data that it's still preliminary estimates, and midsummer we'll have a better set of data with a proper time series on this that we'll be able to stand over better. These are our first estimates of Q1, and it is showing fairly large increases in profits in the manufacturing sector. Another thing we've kept a very close eye on over a number of years is our trade with the UK. So while it's taken a backseat to COVID, perhaps this quarter, we are still keeping a close eye on it. What this is telling us is we've gone back to a deficit from the surplus we've had in the current account balance of the UK last quarter, mainly because of increased income outflows, like perhaps in previous quarters. But the strong feature is continued high computer services exports to the UK from companies in Ireland. Then lastly, to look at the financing, there's some movements between portfolio and other investment, but I guess the best way to look at this is the net liabilities of Irish residents to non-residents. And what we can see here in the quarter is government's increased its borrowing. Monetary financial institutions, these are retail banks essentially, have increased their positive positions with non-residents. And then in non-financial corporates, we can see there that the IP funding, as reflected in that number there, is a more negative balance, so more liabilities to fund the IP based in Ireland. So in summary, we have a current account balance in Q1 of minus 15.2 billion, mainly due to these imports of intellectual property. We've noticeably reduced royalty imports by the pharmaceutical sector. The current account with the UK is back into a deficit, but with strong exports of computer services. And largely to sum up, I think the international accounts are pretty much unaffected by COVID in Q1, and we'll have to look to Q2 to see what happens next. Thank you.
So just to recap, GDP in the first quarter of 2020, on the basis of these provisional results, is showing an increase of 1.2%. As we have said through this presentation, that result has to be carefully interpreted because we have both the restrictions associated with COVID-19 and also some major globalisation events that are part of the picture here. GNP showing an increase of 0.1%. And then we get to the two key indicators for, I suppose, underlying activities in the economy. We have personal consumption expenditure showing a decline of 4.7% and modified domestic demand. So that's government spending, personal spending and investment adjusted for globalisation events. And we show there, that shows a decline of 1.6%. Thank you very much for your attention.